In this video, we're going to answer the question, what is the impact of inflation on the stock market? Before starting, do like the video and subscribe to this channel for future updates. The stock market can be significantly impacted by inflation because it impacts both investor purchasing power and the quality of equities. When prices for goods and services rise steadily over time, it is said to be inflation since the purchasing power of money is reduced. The effect of inflation on the stock market can be complicated and influenced by a number of variables, such as how severe the inflation is, what central banks do, and how well various corporations perform. Higher costs for government. There are various ways that inflation can raise the price of government services and programmers. First, the price of delivering government services may rise as the cost of production rises as a result of inflation. This comprises, among other things, the price of labor, raw materials, and equipment. Inflation can also raise the cost of borrowing for government because higher interest rates may be necessary to control it. Political instability. When inflation is severe, prices for products and services grow quickly, making it difficult for some individuals to afford even the most basic necessities. As a result, there may be social unrest and protests as citizens call for changes in their administration. Political leaders occasionally implement policies in response to popular pressure that are not economically sound or worsen the inflation problem, such as increasing the money supply or imposing price restrictions. Reduced real estate values. Because higher inflation rates can raise interest rates and make it more expensive for people to borrow money for mortgages and other loans, this might result in a decline in real estate values. This might result in less interest in buying real estate, which would bring prices down. Lower fixed income returns. The interest rates paid on bonds and other fixed income assets may not keep up with inflation, which can result in decreased fixed income returns. For retirees and other investors who depend on fixed income investments for income, this may be challenging. The purchasing power of money gradually declines over time when inflation rates are high. International trade impacts. The relative pricing of products and services in various nations are impacted by inflation, which can have a considerable effect on international trade. When one country's inflation rate is higher than another's, the country's goods and services are often more expensive than those of other nations. This may result in a decrease in demand for its exports and an increase in demand for its imports, creating a trade deficit. Stock market volatility. The impact of inflation on business profits and earnings can cause stock market volatility. When inflation is strong, the price of labor, raw materials, and other inputs rise, which can impact a company's profit margins. As a result, investors may expect future earnings and profitability to decline, which can cause stock prices to decline. Increased production costs. Because it drives up the cost of labor, raw materials, and other inputs, inflation can cause enterprises to incur higher production expenses. Business profit margins may be impacted because of the requirement to raise product pricing to cover the increased costs. Wages and incomes may also increase during periods of high inflation as workers seek higher pay to keep up with the rising cost of living. Because of this, firms may experience greater labor expenses and lower profitability. Increased borrowing costs. Lenders may request higher interest rates in response to an increased risk of inflation, which can drive up the cost of borrowing for both firms and individuals. This may increase the cost of borrowing money for operational funding by enterprises or by individuals for major purchases like a home or automobile. Reduced savings. As the purchase power of money declines over time due to inflation, savings may likewise lose some of their value. The real value of savings drops when inflation is higher than the interest rate on savings accounts, because the money received could not be sufficient to keep up with the rising cost of goods and services. Decreased purchasing power. A reduction in purchasing power can also result from inflation, since higher prices mean that a given amount of money can now buy fewer products and services. Individuals' quality of life may be impacted by this, especially those with fixed incomes or low financial resources. When inflation is high, prices for goods and services rise quickly, making it harder for consumers to maintain their previous level of consumption. So, what do you think of this video? Do let us know in the comment box below. Hey, please like this video and subscribe to the channel for future updates, and we'll see you in the next one.